time, so I appreciate that. I know he does a great job working with you. And one of the draws for this morning's presentation was if you came and listened to the product and sales presentation, that we're going to give you a CE certificate on the way out. So even if you can't stay for lunch, don't leave without getting a CE certificate. These certificates are good for one free class on us, on an online class. Now, that could be any place from 1 or 2 credits, or if you're in some of the CLU, CHFC programs, you can still do those online. You can get up to 8, 10 credits with one class. Just out of curiosity, who drove the longest to get here? Did anybody? My commute was 5.5 hours. Was anybody longer than that? Nobody's longer than 5.5 hours. Who was closest to that? And anybody over 3? Anybody over 3 hours?
Yeah. Tony, what were you at? I don't know. It's probably an hour and a half.
Hour and a half? Was that the longest drive?
No.
You were 3.5?
You're south of me, Tony.
Oh, an hour and a half.
I'm in Leon.
You're in Leon, oh, yeah.
Yeah.
2.5? 2.5? 2.5's the longest? Going once? Going twice? Sold. Don't let me forget then. Both of you, you can have 2 free CE online classes. So I appreciate you making the trip. You can always give it to somebody if you want it.
You just got 4.
So, all right, so raise your hand if you have sold a long-term care insurance policy. All right, and I'm assuming that those were all traditional long-term care. Raise your hand if you've sold any asset-based long-term care, which means you've tied it to a life insurance or an annuity. All right. This is such an important topic and a hot topic. It's I've spent now, this is 36 years in financial services, but the more important number is the last 26. For the last 26 years, this is all I've worked with, is asset-based long-term care. And I've seen just huge changes in the industry and how people are looking at these concepts. And so I've got a little cartoon thing to show you first. It's my version of the paradigm shift, because what's taking place is, for those of you that raised your hand that you sold traditional long-term care, was it an easy sell? Do you see that all of your customers can't wait to get it?
No.
Everybody you recommended to, they're like, oh, absolutely. How much can I buy? Was that the sale? About 4th. Because that's what we're seeing. You know, it's interesting. I talk to so many agents that say well over 50% of their clientele is age 50 and older. And then we say, okay, well, what percentage owns long-term care insurance? And it's usually 10% or less. If you have 25%, you know, you're on the high end. And so the question is, if it's so important, and especially now, because most of these people have some first-hand experience, they've had a parent or a spouse or some other relative that's gone in, so they know that they should do something about it, but they still can't pull the trigger. And so the question is, what's happened to them? Oh, yeah. I was missing my wife because I didn't have to pay anything lately, so I'll give my credit card to you.
Cash is fine. I'm going to go to Jordan Creek Mall for a second, so we'll see you at noon.
Can I have that when you're done with it?
Yeah. Do you need the,
Thanks, Gary. Gary's actually treating for lunch.
do you need the security code on the back? 408.
Okay. Thank you, sir.
So the question becomes, what is it? Just in time. So what is it that makes it such a difficult process? And it's a difficult process. We tend not to want to talk about it. So here's my version of this little paradigm shift that's taking place. I think the problem is that we put you up on a tight wire. When you don't want to talk about long-term care because too many bad things can happen. See, the first thing is you start talking about the benefits. Well, how much monthly benefits should I have, and how long should this last? And none of the traditional companies offer lifetime benefits anymore, so how long should this last? And you start playing around with those numbers, and you finally get to the part where you think that you have them convinced that this is a good plan, and then they see articles like this in the newspaper, and this is in the USA Today. If you've got $730,000 for long-term care, you're set. Now, why did they choose that number? Because the average Alzheimer's claim is already up to 8 years. All right, so they're saying you need $750,000 if you're concerned about Alzheimer's. So the problem is, those questions come up, and they say, well, how does my plan cover Alzheimer's? And you say, well, we're going to be a little short, and then you fall off the wire, right? Let's say you get past that obstacle, you get back up there, and now you're going to talk about long-term care guarantees and values. Well, I can afford these premiums, they seem reasonable for the benefit. I mean, I'm looking at these premiums, and if I multiply this out to my retirement age, and I look at if I had a claim, boy, I make out pretty well. I'm getting a lot more in benefit than I paid in premiums, but are these premiums guaranteed? And then you get the next bit of good news. There's not a single company on the traditional side that is still offering 100% guaranteed premiums. And in fact, just the opposite. They're warning you that you should plan for future rate increases. I was doing a client workshop not too long ago, and this lady was kind enough to bring in her renewal notice from the Snoopy company. And I blacked out all the names and the policy numbers, but she made a copy and said, no, yeah, definitely show it. The first sentence of the second paragraph is the key part here. I'm sending you this letter to inform you that we are implementing a 102% premium increase. What does that mean? They doubled their premiums in one shot. So all of a sudden your customers pass the first obstacle and they get to the second obstacle. Well, I can afford these premiums now. Are these premiums guaranteed? And then they find out about companies that are taking substantial rate increases, and so you have to pass that bit of bad news on. And they say, well, that's okay. At least I can, if I decide that I don't want that big rate increase, I can walk away and I'm going to get some of my cash back, right? No, there's no cash value in that contract. So what you have is gone. And so that leaves them in this dilemma. Well, I got this big rate increase. I want to drop it, but I'm afraid of dropping it now because I'm close to using it. So once again, they're off the wire. So let's say you get past that point, you get them back on the wire, they get closer. Good news, good news. It looks like, you know, we were healthy right up to the day we died, but what if we never need this? What does it pay at death? And then what's the answer if we never need the long-term care? Once again, they're falling off. And so the problem here is there's some good companies and some good products. So back up if you think I'm trying to bash these companies. I'm not. There's some good companies with some good products. But the perception from the public is, boy, this is really pricey with no guarantee, and if I never need it, it's gone. Now, and then what's the exposure to you? Because now all of a sudden they're saying, well, this is what they brought to me. This is the best they can do. Well, what about some of their other suggestions? You know, maybe I should be, if I'm going to talk to somebody else about long-term care, maybe I should be listening to what they say about everything that you plan. And so agents just don't want to talk about it. Why open it up? You know, why expose all your work to somebody else? So what I want to do is I want to get you off the tightrope. I'm going to put you on the golf course. And if there's people in here that don't play golf, you don't have to play a whole round, and trust me, it's not really all that boring. And we're not going to play the whole round. We're just going to play one hole. It's a par 4. But here's the concept. The first thing, what's the first thing that you have to do on the golf course? The first shot is the drive. You know, and you really want to boom one down the middle. And I get to play in a lot of golf outings for insurance company meetings, you know, and they always tee me up. There's 4 of you that go out. It's a best ball scramble. And there's always one person in the group that can hit it a ton. You know, it's like, all right, 300 right down the middle. Beautiful, all right? So this is how much benefit should I have and how long should it last? This is our booming 300-yard drive right down the middle. We can give you, what are you looking for, 8,000, 10,000 a month? You want unlimited lifetime benefits? Hey, we got it. That's the home run. That's the beautiful drive right down the middle. But not everybody hits it like that. If you've ever seen me play, you know I don't hit it like that. I'm what they call a Republican golfer. Everything goes way right. So, what's this? This is my drive. It's much shorter and it's not very straight. Well, but we're still advancing the ball closer to the hole. So this is just, well, with our product, if you put it into the lifelong term care, even if you don't have unlimited lifetime benefits, we can put the rider on that still doubles your death benefit. So for example, you put in 100, you have a death benefit of 200,000, we can turn it to 400,000. You can't afford lifetime? That's okay. We can turn 100 into 400,000. So you're still making an advancement, all right? So we're still moving the ball down the road. You don't even have to put the rider on if you don't want to. For some of our people, they said, just turn it into a death benefit. Leveraging my money and turning it into a death benefit that can all be used for care. That's already a huge improvement. So we're moving it forward. Even if you didn't get all the way up to the green, we're moving it forward. You're not falling off any place. Well, what about the second shot? Second shot, typically you want to get a nice second shot and you want to get on the green. So the second shot here is those values, the guarantees and the values. Well, here's the beautiful part about our products. Let's start with the life long-term care. It's a whole life insurance chassis. So you know there's whole life, there's term, in between you've got universal life, variable life. So this is a whole life chassis. Everything in whole life is 100% guaranteed. Guaranteed death benefit, guaranteed premium, guaranteed cash value. Everything is guaranteed. A lot of our stuff is single premium, but if you're doing the ongoing payments, it's whole life. It's 100% guaranteed. There can never be a premium increase on a whole life chassis. It's not allowed, all right? What about the rider? You can buy the rider also as a lump sum of ongoing payments. Once again, 100% guaranteed. It's a non-cancelable rider, and I'm going to show you that in the illustration. So for those of you that maybe sold disability income in the past, there's two types of insurance. There's non-cancelable and guaranteed renewable. Guaranteed renewable says you're insured. They can have the policy for as long as they want, as long as they pay premiums on time. But the company has all the control here. They can increase rates based on claims experience. That's what all traditional long-term care contracts are. They're guaranteed renewable. Ours is non-cancelable. What does non-cancelable mean? It means it can never be increased. So now we've got a whole life chassis and a non-cancelable rider. You're always locking in the premium forever. It can never go up. That was one of the biggest objectives. When we talked to customers about their long-term care insurance, what was one of the biggest concerns? Well, huge rate increases. Can't happen here. Well, what if they did want to walk away, though? What about those values? Well, because it's a whole life chassis, there's also cash value accumulation. Obviously, there's a lot more in there right up front if they did the single premium, but even if they go pay as you go, you're going to see on the illustrations that the cash accumulates pretty quickly. If they want to walk away, they can get the cash back. So now we're on the green. So once you get to the green, what happens? The key here is get in the hole. You might have heard that phrase, drive for show, putt for dough. So there's a lot of people that can hit the ball a long ways, but when they get on the green, they don't putt very well. So you want to putt well, to get a good score. So what if you don't use it at any time? So we said, the rates aren't going to go up. You can turn and walk away and get cash back. Well, what if you never need the long-term care? What happens at death with ours? Well, if it's the life long-term care, we're passing the death benefit. In the majority of cases, it's income tax free. There's only one exception, and that's where we're using qualified money. We'll talk about that in a little bit. If it's the annuity, you get all of the annuity value at death. Now, it's not going to be tax-free. They pay a tax on a gain like any other annuity, but the key here is some things are paid at death as well. So here's the key. Instead of that slippery slope on the tight wire, where too many things can go wrong, and every time something goes wrong, they're questioning the plan. The beauty of asset-based long-term care is nothing can go wrong. Everything is guaranteed. There's a payout no matter what happens. If you need long-term care, we're going to leverage the money and it's tax-free. If you don't need long-term care, there's cash value. And the premiums are never going to go up. And if you don't need the cash, we're going to pay something at death. So live, die, or quit. Something is always paid out. That's the beauty of the plan. That's why agents are a lot more comfortable talking about this approach, because I said there's always a payout. Now, I can't think off the top of my head, I can't think of another type of insurance that you might offer where something is always paid out no matter what happens. I mean, if you could do that with auto or homeowners insurance, that'd be great for, for P&C. I mean, you could sell a ton of that if you could guarantee there's never going to be a rate increase, no matter what happens, we're always going to have a payout. So that's the concept. I think that's why we're seeing 9 of 11, but this year, we can already tell, through August, we're on a record pace again. So it'll be 10 of the last 12 years, record growth, record sales. So, some of this you've seen before. It's some of the costs out there. We know that we have to address it. It's getting very expensive. You know, they were saying in 15 it was the average cost was 87. There was an update from January that was showing it was a little over 90,000 in 2016, April of 2016. It's a little over 90,000 a year for private, a little over 80,000 a year for semi-private. You know, they start looking at, what if you put some typical medical inflation on here? What are these costs going to look like down the road? And you see the numbers jump dramatically. So the key is, how can you not talk about this? This is one of the few things that can hit your customer that can wipe everything else out. So you have to have a plan. Now what are some of the reasons these costs continue to go up? First, baby boomers. You know, we've got, what, about 8,000 to 10,000 people a day turning 65. Well, now the even better number is baby boomers were 46 to 64. All right, that was 1946 to 1964. So what happened? 46. We're in 2016. We've got 10,000 people a day turning 70. Now that's going to be even more important. A, they're closer to the point in time where they might need care. B, qualified money. For those of you that work with qualified money, money that's never been taxed, IRA, 401k, the profit sharing, those types of funds, they have to start moving it by 70.5 if they haven't, or they're going to get penalties. We're the only company out there that has an asset-based solution using qualified money. So the baby boomers, that's a big part of why all this is happening. Medical technology, people are living longer, but at some point, things break down. We have to have things fixed, and the cost of those, the medical cost of those repairs is expensive. Family dynamics, people are more spread out than ever before. You know, my father had retired to Phoenix after living most of his life in Wisconsin. He's passed away now. My older brother's in Colorado. I have a younger brother that's back in Wisconsin, but he's about 2 hours from me. So we're all spread out. So if my mom needs care and she's still in Milwaukee, it's who's going to take care? You know, who's closest, or is she going to have to move? So that's an issue as well. The government programs, I think we kind of toss those up. I think you're probably familiar with those, Medicare and Medicaid. Medicare was never designed for long-term care. Medicare is short-term. You know, if everything falls into place, they have to pay up to 100 days. So that's not the solution. Then you've got Medicaid. What's the big problem with Medicaid?
Don't get to pick where you go.
First, you don't get to pick where you go. So, but even before that,
All your assets have to be spent.
you have to be at what level?
I have less than $2,000.
Yeah, you have to be at a near poverty level. And so there are people out there that just never really accumulated much in the way of assets or wealth or income. And that's what Medicaid was for. It was designed to help those individuals. But people that are middle income on up to high net worth, Medicaid should be the last thing that they should be looking at. Moving all their assets away so that they can qualify for a welfare type benefit. Like you said, first of all, there is no home care benefit, and you can't pick which nursing home you go to. They tell you which beds are available. It's not always going to be the closest bed. Now, I can't tell you what's happening in your home state of Iowa, but I can tell you back in Wisconsin what's happening. We did a study not too long ago, and what the nursing homes are receiving from Medicaid to offset their costs is less than the cost of the care. So they're actually losing money on every Medicaid patient. So now, can you make that up in volume if you're losing money on every patient? And the answer obviously is no. So what's happening? More and more of these facilities are saying, okay, we're changing our charter. We can't kick out the people that are in here, but moving forward, it's going to be a private pay only. We can no longer accept Medicaid patients because we're going to go bankrupt. All right? So Medicaid is not the answer. A lot of these numbers are based on averages, and I'm not a real big fan of averages because you know about averages. You know, if I'm standing in ice with my hair's on fire, I should feel good right about here, but probably not. So the only reason I wanted to put this up here is two. There's two things I wanted to point out. With the demise of lifetime benefits on the traditional health care side, long-term care side, they like to point out, well, the average claim in the United States is still less than 4 years. They're right. 2.2 for men and 3.7 for women, okay? So they're right, the average claim is still less than 4 years. But I like to point out that next one. See, because in the top 10 conditions, causes of death, Alzheimer's is the only one in there where there's absolutely no cure for. And a lot of these Alzheimer's patients, as I pointed out earlier, are going to need substantial amount of care. The average claim is already over 80 years. My aunt on my dad's side, she was in for 12 years. More and more, you can talk to your customers and find out, have you any experience with Alzheimer's, any relatives, and you'll find that they're lucky if it was a short claim. A lot of those claims last 6, 8, 10, 12 years or more. So that's what I want to point out about those averages. It's important because of the top end. You don't buy insurance for the average claim or the small claim, right? Health insurance, I mean, are you concerned about, rolling your ankle or having a sore throat? Probably not so much. It's probably not even something that you even consider because what do? They've gone higher deductibles, right? But what are you concerned about? You're concerned about that tightness in your chest that you thought was indigestion. Well, what if that's a sign that you need a bypass? Or if it's P&C, you're probably not concerned anymore about that fender bender. Gone are the days where people had 0 deductible comp and maybe $100 on collision. Everybody's got high deductibles, right? So what are you concerned about? You're concerned that you had 1 glass of wine, left the house, and ran through the stop sign and hit somebody. Now it's a $1 million liability claim. Insurance, what you should be looking at, yes, there's going to be a lot of claims that are more in the middle, but what's the main purpose of insurance is to protect you from that catastrophic claim. And what's the catastrophic claim on the long-term care side? It's back to the Alzheimer's. So I think you've seen a number of these stats before. If you reach age 65, they say there's a 70% chance you're going to use some form of care before you pass away. 40% of those people will be in the nursing home itself. So, so we know we have to address it. So you may never need it. So this is how we like to say it. You may never need it, but if you do, how will it affect your family? And the reason we start by positioning it that way is because we know what and the customers, if you're talking to a couple, who's the one that's sure that they will never need it? The husband, right? The husband always says, it's never going to happen to me. So we want to kind of walk through that whole scenario. Well, if you did need it, who would take care of you? And you can go right down the list and tell them what the rationale is for why relying on the family is not going to be a good solution. If you needed it, though, how would you pay for it? And this is a more important issue because now we can go through where we need to be, and that's, we are talking about the government, they're not the answer. There's long-term care insurance. Some of them have it, but it's going to be a very small percentage. And then there's self-funding, and that's pretty much up to now all that they've known about. Now, what's the problem with self-funding? There are a lot of people at retirement that have some lazy money, some emergency funds, some safe assets, rainy day funds, whatever you want to call it. That's what I would use first if I needed to pay for something like this. All right, so they're less likely to take it out of their income. But what's the problem with that? How are they going to cover that catastrophic claim? That's pretty risky. It's a huge exposure. So what we want to do is show them that that's exactly why asset-based long-term care was put together almost 3 decades ago. It's taking something that you own now. So the question was, if you don't have long-term care and you're going to self-fund, what would you liquidate first to pay for this? And they say, well, I've got that CD. Well, what if we could take that CD and simply reposition it into a life policy? So you still have the cash value, you haven't lost it, you haven't spent it. But now because it's a life policy, we're also setting up a death benefit. And when I first tell people on the client workshops that it's a life insurance policy, they get a little disappointed. It's like, I was hoping it was going to be something really new and exciting. Now I understand that at first because with life insurance, up to now, what do they know about the life policies? What has to take place before there's a claim? They have to die. Well, we're going to change that. We want to educate them. These are set up so that 100% of the death benefit is immediately available for any form of long-term care. All right, so we're going to leverage it. It's not your cash value, it's your death benefit. It's all going to be available for care, income tax-free. If you die, it's tax-free. If you need it for care, it's all tax-free. Then we can take it one step further. We can put a rider on top that'll either double that or give you unlimited lifetime benefits. So what we're saying with asset-based long-term care is something's always paid out. If you need it for care, it can be unlimited lifetime benefits. If you don't need it for care, your cash continues to grow. And if you don't need that either, we're paying something at death. So something is always paid out. That's the beauty of the concept.
Do most of your people that use this, do they do a policy on the husband and one on the wife, or did they do second to die?
Good question, and so I'm going to ask you to hold on to it just for a little bit longer, because that's going to be one of the things we're going to talk about next. So this is not just protection for the customer, not just for the, to protect their assets. This is also protection for the agent if the agent gets involved with things like managing assets. Because there's somebody out there that is trying to take business away from you. And you might think that it's the planner down the street, but it's not. You know who it is? It's somebody that's huge, and they don't even have to advertise, and they can take hundreds of thousands. It's the nursing homes. In 2014, there was $102 billion put into new deposits in mutual funds. That same year, there was $134 billion spent in nursing home care. See, they don't even have to advertise. So if your customer doesn't have a plan, they can just pull this right out. So this makes sense for the customer to protect their assets. It also makes sense for the agent if you're involved with managing assets. It'll protect your clientele. So, the portfolio. Not only have we been doing this longer than anybody else, but we have by far the largest portfolio of asset-based products. Take one of those, pass it. Take one and pass them around back and over. Take one and pass them forward. So asset care. Asset care is trademarked. When you see asset care, that's a whole life policy with long-term care benefits. Now you see there's 4 versions, asset care 1, 2, 3, 4. We're going to talk about 1, 3, and 4 in just a minute. We'll go through the illustrations. Annuity care is a fixed annuity with long-term care benefits. We've got 2 other products down here, legacy care and immediate care, that I want to briefly mention. Asset care and annuity care are the main parts of the portfolio. That's qualified long-term care. Legacy and immediate care, these 2 are not qualified long-term care products, but they complement the portfolio. You're going to run into situations where it's nice to know that we have them. So what are they? First, legacy care. Legacy care is a very vanilla fixed annuity. It's at minimum interest rate of 1%, and it's got a 5-year sales charge, a surrender charge. You said, well, why would we need to know about that? It's a function of the competition. Right now in the United States, there's a little over $2 trillion of non-qualified annuities. All right, so over the last 4 or 5 decades, a tremendous number of people have purchased non-qualified annuities. That means they took after-tax money and put it into an annuity, typically as a lump sum. And then it grew tax-deferred, okay? And the idea was, it's a nice safe place to park the money for now. If I get to retirement, the annuity can give me an income for life, so that's why I want it. Well, what's happened is, a lot of these people in this age group have done pretty well. They're good savers, and they don't need the annuity for an income. If they don't need it for an income, it's just sitting there. Well, what happens? Most of these companies have requirements that you have to annuitize by age 85, 90, or 95. So now this asset has grown to a huge amount. And they want you to start taking it out because then it's taxable, right? A lot of people say, we don't need or want taxable income. Legacy care says, you can take your old annuity and you can 1035 exchange it, you can move it into our annuity. There's no underwriting, you can be uninsurable, doesn't make any difference. We'll take it, and we do that through age 99, so up to age 100, up to, through age 99, they can move their old annuity into ours. They can park it and leave it, defer it until the day they die and let their kids worry about the gain. So legacy care is just, if they don't want to be forced to take an income from their annuity, they can move it to us. So we write a fair amount of those every year, they're always larger cases. Immediate care. Immediate care are for those people that are already in a claim situation. So you're talking to a couple in their 60s about asset care, and they say, boy, I wish we had known about this 10 years ago because mom's in the nursing home right now, and she's going through a lot of her money because she never had a plan. Well, you've always been able to offer a partial solution. You could say, well, depending on what mom has left, we could move a lump sum into a SPIA, a single premium immediate annuity, And that would kick out an income, a monthly income for the rest of her life. So whether she lives 2 years or 15 years, there's a monthly income coming in to help offset some of her expenses. Now a SPIA typically just looks at male or female and age, and then they figure out how much a month they can give you. What we do with immediate care is we're offering a medically underwritten SPIA. We won't even let you quote it unless they're in a claim situation. They're unable to perform 2 of 6 activities of daily living or they have cognitive impairment. So they're already receiving benefits or claims, they're paying claims for long-term care. We can take that same amount and give them a larger income because now we know that their life expectancy has been reduced based on their health condition. Or we can get the same income with a smaller deposit. I'm not going to go into any other detail on that product right now other than to say, here's a handout. And if you just go through this handout and take a look at it,
This is strictly for those that are already receiving care.
they have to be receiving care now.
Yeah, when you use the term long-term care claim, really what you're just saying is that they're already paying a nursing home for their
A nursing home or home care.
Yeah.
A nursing home or home care. And so what you'll be able to see if you just go through this, if you use your own money, like mom's in the nursing home now, and it's $5,000 per month, and she's got to make up a shortfall, she's got a little bit of Social Security. So they're saying if you use your own money, the $350,000 she has, they give you that as a possibility. They show you what you could buy a traditional SPIA, but then if she dies in a short time, the lump sum's gone. Then they show you the last one is our medically underwritten SPIA. The concept here is because of her health, because it's a medically underwritten SPIA, we can give her the same income for a smaller deposit. So not only do we have that income coming in to help offset her expenses, there's still a chunk of her assets that's left over, so something could still be passed on at death. So I'm not going to go into any other detail on this. Take a look at it. It's a neat concept, and you're going to run into situations where you'd like to know about it. So let's get into the accident care product, because that's the line that started all of this back in 1988. We filed it in 1989, we sold it, the first one. We're going to do an accident care 1 example, and I'm going to start by doing a couple, both age 64. So this gets back to Ed's question earlier. Do we write 2 individual contracts or do we do a joint policy? And the answer is almost exclusively, well over 90% of the time, we're going to do the joint policy. And there's a reason for that. So take this handout. It's extremely rare in financial services to get a patent, but we have one. That's what this piece is. We have a patent on the joint life long-term care policy. The patent number is listed here, so if any of your customers want to see the patent or go online to find the patent, here it is, okay? But here's the key. If you look at the diagram, everybody else has to write one of these contracts, one on the husband, one on the wife. That's splitting the money in 2 separate set of expenses. When we pool it, we only have 1 set of expenses, all right? And we're pooling the money, so we should start with higher benefits. Now,